Welcome to readtheticker.com. Within our premium service called RTT Plus, we have a private blog called RTTWC, which actually stands for the Richard Wyckoff Campaign blog. Now, within this blog, we have excerpts under the RTTWC Wyckoff tag there, excerpts of the original Wyckoff manual. And today I'm going to highlight an important part of the manual. And like in the Wyckoff arena, you really want to pay attention to the original word written by Richard Wyckoff. As you can understand, there's been many since 1930 who have taken his words and put their own interpretation on them, from Tom Williams to David Weiss to the folks at the Wyckoff Associates. They've all put their own sort of spin on it. So you really have to go back to the original hard written word of Richard Wyckoff to understand what he was on about. And luckily for us, there are some two very good documents that allow us to do that. And they are the Richard D. Wyckoff Method for Trading, Investing in Stocks. I think it's free on the web. If you do a Google search, you'll easily find it in PDF. Anyway, the section I'm going to look at today is refinements. In the section called refinements, he discusses the comparison between a terminal shakeout and an ordinary shakeout. And here's a definition of a terminal shakeout. A terminal shakeout is a rapid or precipitous downward movement occurring, I'm looking at this paragraph here, occurring at the end, a period of preparation for an advance. That's basically a sharp smash down after a period of accumulation. In this case, of a deliberate manipulation, and it could actually be just frightened sellers giving up. And the purpose is to mop up the weak holders of stock. Now, I'll give you an example from the original work. In the document, we have a chart from the 1930s. This stock called Anaconda. Here we have a period of sideways basing, and then there's a real sharp smackdown for a couple of weeks, and then price recovers and a true rally takes on. Now this would happen in Apple before every major rally, and it always also happened in gold and S&P 500 before ever the market took off on a markup process. There was always a period of accumulation. Then the composite man would smash down into the stop zone and bust all the stops, then shoot up. Here's an example on the PDF. There's another stock, Atkinson. Here we have a little basing pattern and a sharp smash down that's recovered. It's just saying to the people out there who've been buying the stock, if you've got the metal, can you hold this through a 10% plunge? Because we know the big boys can, because they've got the money and the power. But the retail traders, they don't really have the bottle. So a terminal shakeout is a test of the metal of the investor. And quite frankly, it's one of the best buying strategies you could have out there, to see a period of accumulation, a smash down into new ground, and a power buy up. It's probably one of the best signals on the market. Of course, the inverse of a terminal shakeout after accumulation is on distribution. We have a period of distribution that shoots up and smashes back down. Okay, let's have a look at a current example. One that's in progress, I should say. Okay, so here we have a silver stock. I think the symbol is SLW. They had a bit of a rebound on Friday. We've got an accumulation zone there, we believe to be accumulation. Here we had a smash down into new ground. At the moment, we're getting a bounce back. So it's, like I said, it's a potential terminal shakeout that has to be confirmed. We'd like to see the close scream above $20. So this is a monthly chart, so we've still got a couple more weeks in the month to go. Like I said, this is a potential terminal shakeout where it's actually gone. We had a period of accumulation. We smashed into new ground to bust the stops, to freak out the weak holders. The people who've been accumulating here think they made a wrong decision in buying this here, and the stronger hands are pushing it down to scare folks out, and we'll get confirmation that demand is truly there when it breaks up a bit higher. Like, remember, I'll just be careful, it's a potential terminal shakeout. Another one, of course, is gold. We've talked about this on the blog before. We have had a period of accumulation. Smashed into new ground, busted some stops. Yes, we had our first decent rally on the Friday, which is good, but it's still to be confirmed. It's actually a bit of quite frankly, it's a bit of a high volume spring. High volume spring or terminal shakeout, it's pretty much the same sort of language, but we need it to go much higher and hold its ground to confirm that there was a true demand. I'm going to use the word potential again because it's not yet confirmed. We have to watch it the next couple of weeks to see how it unfolds. But it has the right characteristics. Accumulation, people hopeful that it's going to go up. Then it's a smash down to bust the stops to see if the stronger hands can really shake out the weak hands to see if they can really hold through this busting the stops process. The terminal shakeout, for example, is very common in periods after periods of accumulation, especially in strong markets. There's another one there. Once again, here we have the smaller one here. Of course, here's another one here. Different degrees, of course. Yeah, minor one here. And most major uptrends are where the public know or get the impression that price is going to go higher. The stronger accounts try to test the mettle of you holding your position by going lower, try to bust stops to create news and fear, and hopefully that you can release your shares and your investment to the stronger hands so they can gain more profit. Thanks very much for watching.